Look, here's a puzzle that stopped me cold. Peter Thiel just dumped every single Nvidia share his fund owned. All 537,000 of them gone. Meanwhile, on the other side of the chessboard, Warren Buffett quietly loaded up on Alphabet, dropping somewhere between $4 and $5 billion on Google's parent company. Two legendary investors, two moves that look like total opposites. One bails on the hottest AI chipmaker on the planet, the other dives into a search and cloud giant that's pouring tens of billions into data centers. So what gives? Are they betting against each other, or is something bigger going on that we're all missing? Here's the thing. If you dig into what's really happening, these aren't opposite bets at all. They're actually the exact same call dressed up in different clothes. Both of them are reacting to a phase change in how the AI gold rush pays out. One guy's saying the picks and shovels boom is running out of oxygen. The other saying the real money is about to show up where AI finally meets customers. To understand why that matters and why it could flip the whole market on its head, we need to map where value actually flows in an AI cycle. Because if we get this wrong, we might be holding the bag on the biggest stock in the world just as the wind turns. So let's go first principles. Every innovation boom monetizes in two distinct phases. Phase one is the build out. You need infrastructure, you need compute, you need factories churning out the gear that makes everything else possible. Think about railroads in the 1800s, telecoms in the 90s, or data centers in the cloud era. Whoever sells the shovels and the rails makes a fortune, while everyone else is still figuring out what to dig. That's been Nvidia for the last 2 years. Phase two is different. Phase two is when the infrastructure is already there, sitting idle or humming along. And the question becomes who can squeeze cash out of it by actually touching customers. Software, services, ads, subscriptions. That's where the enduring profits live. So if both Thiel and Buffett are right, the only logical explanation is we're shifting from phase one to phase two, from scarcity of compute to monetization of what that compute can do. Now, how do we know phase one is running out of gas? Follow the capital expenditure. Capex is the fuel that powers the hardware trade, and it's also the input cost for every application that rides on top. In 2025, the hyperscalers went absolutely berserk. Microsoft said it would spend around $80 billion. Alphabet cranked its number from $75 billion to $85 billion, all because demand and backlog kept climbing. That frenzy pushed Nvidia to a $5 trillion valuation, the first company ever to cross that line. Every chip they shipped had a buyer lined up before it left the factory. Classic picks and shovels surge. But here's the uncomfortable truth. That kind of spending can't keep accelerating forever, and the moment it slows even a little, the entire chain reacts. Why does it have to slow? Because after a Capex binge comes the inevitable hangover. Every dollar of new gear you buy shows up on your balance sheet as depreciation over the next few years. That means your profits look smaller, your return on investment comes under a microscope, and every CFO on earth starts asking the same question. Are we actually making money off all this shiny new hardware, or are we just building castles in the sky? When that question lands on the boardroom table, optional projects slip. Future capacity orders get trimmed. And the first place you cut is the next batch of GPUs you were planning to buy but haven't signed yet. That squeeze travels upstream fast, and it hits the hardware supplier who's most levered to incremental orders. In other words, it hits Nvidia. We've already seen early cracks. Alphabet's CFO warned that higher AI capex would make profits look worse as depreciation climbs. Microsoft canceled some data center leases even while publicly reiterating big spending plans. Those are friction signals, little warning lights blinking on the dashboard. And history tells us what happens next. When buyers of capacity slow down, hardware leaders stumble hard, even if the long-term technology trend is still intact and growing. Let me take you back to 2001. The internet was real, traffic was exploding, but telecom companies had overbought capacity in the late 90s. When the Capex tap turned off, equipment giants like Cisco saw sales collapse, inventory pile up, and stock prices cut in half, or worse. The internet didn't die. The build-out cycle did, and the vendors who supplied the build got crushed. That's the risk smart money sees coming. They don't wait for the earnings disappointment to show up in a quarterly report. They front-run it. Thiel Macro sold every Nvidia share in the third quarter of 2025. SoftBank offloaded nearly $6 billion of Nvidia stock in October to redeploy into other AI bets. Meanwhile, Berkshire initiated a top 10 position in Alphabet and trimmed Apple. These aren't random moves. They're coordinated reallocations away from the most capex-sensitive node in the stack, which is GPUs, and toward businesses that can capture cash from AI without needing chip shipments to keep climbing forever. So the question becomes, why Alphabet? What makes Google's parent the logical destination when you're rotating out of the infrastructure layer? Here's the answer. Alphabet sits exactly where cash meets AI demand. It sells ads, it sells cloud contracts, it sells subscriptions. All of those monetize usage, not the scarcity of silicon. Google Cloud reported a $106 billion sales backlog, with over half of it expected to convert into revenue within 2 years. That's real contracted demand, not speculative hype. Alphabet raised its 2025 Capex to $85 billion, sure, but that spend is building out capacity to meet signed customer commitments. It's not betting on a future surge, it's fulfilling orders already on the books. And crucially, Alphabet doesn't care if the chips inside its data centers come from Nvidia, AMD, or its own homegrown TPUs. It owns the customer relationship. It owns the data. It owns the distribution layer where AI applications actually generate revenue. That's the application layer thesis, and Berkshire's buy is a giant validation stamp on it. Now, if investors start rotating at scale from hardware to application platforms, the market structure itself becomes fragile. Right now, Nvidia is insanely concentrated at the top of every index. By late October 2025, it became the first company to hit $5 trillion in market cap. One analysis found that Nvidia alone drove nearly 19% of the S&P 500's gains through September that year. When a single stock is that big and that concentrated, passive flows, options hedging, and earnings expectations all move in lockstep. If leadership shifts and money starts flowing out of Nvidia and into diversified platforms like Alphabet, Microsoft, or Amazon, the mechanical effect on the index can be huge. Selling the leader moves the whole tape. That's why a leadership rotation doesn't just change your portfolio. It can topple the entire AI rally, at least temporarily, even if the underlying technology story is still strong. So what does that mean for you and me? It means we need to track two things like hawks. First, watch the Capex inflection. Are the hyperscalers still raising their spending guides quarter after quarter? Or are they starting to talk about discipline, efficiency, and return on investment? Second, watch backlog conversion. Are cloud providers turning those giant backlogs into actual revenue and profit, or are customers pushing out timelines and renegotiating deals? Those two signals will tell you whether leadership is about to flip before the price does. And if you catch that shift early, you can position yourself on the right side of the rotation instead of getting dragged down with the crowd. Here's the bottom line. This isn't AI is over. It's not even close. What we're seeing is phase 1 peak risk colliding with phase 2 opportunity. The factories have been built. The compute has been deployed. Now the game shifts from who can supply the shovels to who can charge a toll every time someone uses the road. Thiel de-risking GPUs and Buffett owning application layer cash flows aren't opposites. They're two sides of the same trade. Both are saying the scarcity premium on chips is fading, and the durable money is moving to the businesses that sit between AI and the customer's wallet. And that rotation, that quiet reallocation of trillions of dollars, is the signal hiding in plain sight. By the way, the hyperscalers aren't sitting still either. They're developing their own chips. Google has TPUs, Amazon has Trainium and its own AI project, and AMD is ramping up its accelerators to compete with Nvidia. More supply plus tighter ROI scrutiny means the scarcity premium narrows. Over time, which reinforces exactly the rotation we've been talking about, the winners in phase 2 won't be the ones who built the most chips. They'll be the ones who compound cash off the infrastructure that's already in the ground. So if you want to survive and thrive through this shift, ask yourself one question. Am I betting on the next build, or am I betting on the businesses that monetize the installed base? Because right now, the smartest money in the world is moving from factories to toll roads. And if you're still chasing the factory, you might be about to learn a very expensive lesson about cycles. If this breakdown helped you see the board a little clearer, hit subscribe so you don't miss the next one. Drop a comment and tell me where you think the rotation goes next. And share this with anyone who's still trying to figure out what Thiel and Buffett are really up to. Thanks for watching, and I'll see you in the next one.